Oil prices are rising due to a lot of news happening, a lot of things happening in the oil markets. Demand is increasing. The oil inventories are dropping. We are drawing down the oil inventories consistently. OPEC plus compliance, Russia, Saudi Arabia, and all those guys in the Middle East are doing well, working together, curbing production, reducing the amount of oil glut that is out there. The Middle East is becoming more hostile by the second. Houthi rebels are not giving up. They continue to bomb Saudi oil facilities. Russia and shale oil and gas has peaked their output, and they are declining as far as oil reserves. I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. I take all the news that I read throughout the week regarding the oil and gas industry, and I share it with you. Oil prices right now, WTI crude trading at $63.22. Brent crude is $66.84 per a barrel. Oil prices jump as EIA reports a crude draw. Crude oil prices climbed on Wednesday morning after the Energy Information Administration reported crude oil inventories had shed 5.9 million barrels in the week to April 9th. This compared with an inventory draw of 3.5 million barrels for the previous week. So we continuously draw down the crude inventory supplies. OPEC's bullish demand data sparks hope of a new oil rally. OPEC has revisited its 2021 oil demand upward to stand 190,000 barrels per day higher than last month's estimates, on the back of an economic rebound that surpasses last month's outlook. Global 2021 oil demand is now expected to average 96.46 million barrels per day for the full year, according to OPEC's latest projections included in its April monthly oil market report. That figure is up from 96.27 million barrels per day in last month's report, and up from the newly estimated 2020 oil demand figure of 90.51 million barrels a day. In last month's report, OPEC had estimated 2020 global oil demand at 90.39 million barrels per day. This upward revision comes after the group's de facto leader, Saudi Arabia, told the group at the last OPEC meeting that the oil demand figures they were using were too low and that actual global oil demand would be higher. And so everybody is, the analyst, Saudi Arabia, Russia, everybody is increasing oil demand outlook. Russia, OPEC to gradually ease production cuts in May, July. This is a report that just came out minutes ago. The OPEC Plus alliance will gradually ease the collective production cuts between May and July, as the ministers agreed earlier this month. Russia's Deputy Prime Minister Alexander Novak told reporters on Friday. So a lot of analysts, a lot of oil traders, investors wait upon the reports of OPEC Plus compliance to determine what they expect with the oil prices in the coming months. And so they continue to work together. They continue to stick to their plan to curb enough oil production to get rid of this oil glut, and they're doing very well. Russia, the key partner of OPEC in the OPEC Plus group, decided together with its allies led by Saudi Arabia to ease the collective production cuts by over 1 million barrels a day over the next 3 months to July. So here's the deal, guys. Oil prices are going to continue to be balanced properly. Okay, these guys are not going to allow oil prices to fall, and they are desperate. Most of their GDP, Russia, Saudi Arabia, these other countries, most of their GDP is reliant on oil, heavily reliant on oil, as where America is 8 or 9%. Okay, their GDP is made up of 8 or 9% of oil and gas, and it's becoming less important to America. These guys are desperate for high oil prices to balance their economy. Oil edges up to the fresh 4-week highs as demand outlook improves. U.S. retail sales rebounded more than expected in March as Americans received additional pandemic relief checks, and COVID-19 vaccinations allowed broader economic re-engagement. Wednesday's gains were a bit excessive, but they were built on valid grounds as several high-profile reports forecasted demand growth for the second part of the year, and as crude stocks in the U.S. surprised traders with quite significant draws. The EIA and the Organization of Petroleum Exporting Countries this week made upward revisions to their global oil demand growth forecast for 2021 to 5.7 million barrels per day and 5.95 million, respectively. U.S. crude inventories, meanwhile, fell 5.9 million barrels last week. Supply discipline and rebounding economies are set to give oil a chance to break out of the recent range, analysts at Goldman Sachs said in a report. We remain positive on Brent oil forecasting $80 per barrel in the third quarter on a near-term demand recovery and supply discipline, the bank said. OPEC and its allies, including Russia, a group known as OPEC, agreed to bring back about 2 million barrels a day of production over the next 3 months. The United States, meanwhile, imposed a broad array of sanctions on Russia to punish it for the alleged interference in the 2020 U.S. election, cyber hacking, bullying Ukraine, and other malign acts. So I'm telling you right now, Russia is not going to like what Biden placed upon the backs of Russia. I mean, these guys have worked so hard to help balance the markets, and now they are getting sanctioned to death because of what they're doing in Ukraine and the buildup of all those troops. It's not going to be good for the Middle East, because the more pressure you put on Putin, the more he uses his blunt force to manipulate and control prices. Because right now, if those sanctions destroy his ability to export more oil, it's going to mess up the plans that he's committing to OPEC plus. And so it'll be interesting to see what happens here in the next coming months here. But I think it's going to make him even more bullish, more aggressive in his plans in the Middle East. And it is not for peace. It is not to lose power. It is not to allow oil prices to drop down to $20, $30 a barrel. He is going to do whatever he can to keep control of what he has in the Middle East. He's growing in power. He's partnering with China. He's dropping bombs through the Houthi rebels as a proxy, okay? And so that is increasing oil prices. That is another chess piece on the board that he uses to manipulate oil prices. And it's not just OPEC plus to curb production. He uses military force to curb production and to bring instability in the Middle East to increase oil prices. Oil prices mixed even as China data points to strong rebound for demand. The energy markets have so far been besetted by monthly reports that point to a healthy recovery from the pandemic, as well as tensions between the U.S. and Iran and Russia, which could have some impact on crude markets. On Friday, the focus was on China, which reported that its first quarter gross domestic product jumped 18.3% on year-on-year basis. A report on retail sales for People's Republic, one of the biggest importers of crude, also showed more than 35% rise. On Wednesday, the International Energy Agency lifted its demand outlook for crude as U.S. government reported revealed a third weekly drop in weekly inventories. China's GDP growing bodes very well for oil because they are one of the biggest oil importers in the world, along with India, and them growing their imports by 35% bodes very well for oil prices. U.S. oil drillers dying on the vine as PE flight prompts funding drought. Okay, private equity. Stricken operators launched last gasp efforts to boost cash flow and attract buyers. I mean, these oil and gas companies are desperate for financing and they're not getting it. A vital source of funding for the U.S. oil sector is drying up as private investors retreat, prompting stricken operators to make last gasp efforts to boost production and cash flow to lure in buyers. The exodus mirrors Shell's experience in public markets, where even before last year's crash, investors had sourced on an industry notorious for poor returns and weak environmental, social, and governance performance. Private equity has been decimated in this shutdown, said Will Van Loo, head of Quantum Energy Partners, one of the largest PE investors in the Shell patch. The total quantum of money available out there to provide private companies has shrunk and is going to stay much, much smaller. Now, scores of oil producers are dying on the vine, said Ben Dale, managing partner at the Revell Kimbridge, as they are left without the regular cash infusions to bankroll the capital spending needed to keep on drilling. The private flight comes despite oil recovery to $60 a barrel, a price that allows many operators to break even and has raised investors' hope of a profitable final exit from the sector. This business is broken. The industry is going through a multi-year process of wringing capital out of the sector, not bringing new capital in. Between the start of 2015 and the end of 2019, 136 private funds closed after raising an aggregate of $86 billion to spend in U.S. oil and gas, according to Preqin financial data. The influx helped to finance an unprecedented surge in American oil production to record high of about 13 million barrels a day last year. Okay, so obviously that's not the case at this point. And as you can see here, U.S. private equity is ditching shale. And as you can see, it has dropped substantially. 2015, we're upwards of 50 billion. It jumped almost as high as 70 billion. And now here we are in 2021, and it dropped as low as 9 billion. Okay. And so the capitalization of the oil and gas industry, it's undercapitalized. Just 11 funds closed last year and only 4.5 billion was raised as oil prices crashed, according to Preqin. Production plunged and remains around 11 million barrels a day. And so because of this undercapitalized industry, guys like me could take advantage and go in and pick up leases, pick up premium acreage for pennies on the dollar, developed for much cheaper conventional oil and gas plays. And it's been going very well. U.S. oil bankruptcies shoot up in Q1 2021. Okay, so of course, shale companies are going into bankruptcy. They're underfunded and their production is dropping. The Permian faces an empty pipeline crisis. It's more than possible that the U.S. shale industry will never break its production records. Of course, U.S. shale isn't dead, but it is far from a sure thing that the sector will ever be able to return to its full pre-pandemic glory. No one knows for certain whether we are already experiencing peak oil, but there are plenty of experts that say if we haven't already peaked, we can expect to in the very near future. At present, United States crude output is hovering around 11 million barrels a day. Some analysts are expecting more of a recovery in 2022, but very little growth is projected for the duration of this year. In fact, nearly half of all pipelines leading out of the Permian Basin are projected to run completely dry by the end of 2021, according to reporting by Reuters. By the fourth quarter, total utilization of the largest oil pipelines from the Permian is expected to drop to 57%. The report summarized findings from global energy research and consultancy group Wood Mackenzie. So they built up the infrastructure as fast as they could because the oil and gas shale revolution was growing at extravagant rates. And now all of those pipelines are going to be reduced as far as the usage because quite simply, we're underfinanced. Shale has a very fast decline. Okay, most of your conventional wells drilled back in the 80s, 90s, 2008, those have a very slow decline because it's conventional. Most of your Middle East oil is conventional. Russian oil, conventional oil. Unconventional oil is shale, very tight formation, millions and millions of dollars to complete to frack it, those wells, and their decline is very quickly. So that's why you're going to see a very quick decline with under financing. Shale to exhaust dwindling oil and gas reserves by 2040. So by 2040, Shell expects to have produced 75% of its current provided oil and gas reserves by 2030 and only around 3% after 2040, Supermajor said. We are peaking as far as oil production, and unless we find new oil reserves, we're going to lose most of our American U.S. oil that we've worked so hard to build. We've got a tremendous amount of evidence that oil demand is increasing, that oil production is decreasing, that reserves are being depleted. And the shale industry continues to dwindle substantially. Bankruptcies are happening quite simply because it's being underfinanced, okay? And so oil prices are en route to be back to 2008 prices. When oil prices hit over $140 a barrel, we were producing 6 million barrels a day. We are not too far away from those scenarios again, quite simply because unless shale finds a new way to produce oil, we're en route for that. All right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe, and we'll talk soon. Thanks.